Rahul Chadha on the show with us to talk about what he's making of the market right now. Rahul, hi, afternoon. Good to have you on the show. And what is it that you're making of the market right now? I mean, all the valuation concerns aside, markets, and not just us, globally, they don't want to stop.
Yeah. No, I think what markets are looking is what Fed would do tomorrow. So September 18th is when Fed comes for a meet. And clearly, we're seeing globally economic data being soft. But the hope is that policymakers, particularly here, the central banks come quickly, act quickly, and cut rates quickly. So, which is where 50 bips cut from Fed would be reassuring. And we've had some statements from the Fed members saying that Fed should go to neutral rates very quickly. So should that happen in the US, that would give room to the policymakers here in Asia, particularly RBI, to cut rates because there is growth slowdown. And I've been in India for last couple of days, and there are visible signs of slowdown, whether it's real estate done in India or consumption part of the economy. Yeah.
Oh, so if you're in India, perhaps you should have joined us from the studios itself, Rahul. But good to be speaking with you in any case. But do you think if there is a 50 basis point cut, do you think that spells deeper worries? Because the slowdown that you're talking about, that would just raise the red flags. Or do you expecting that 50 basis point from Fed is the base case scenario right now?
Okay, so that 50 basis point cut, historically, markets have got worried on that cut because markets kind of think that Fed knows something which we don't know. There is a bigger issue, but we're not seeing that kind of a tightening, or we've not seen the stress in the credit markets. Historically, those kind of cuts happen when there is stress in the credit markets. And something which we've talked before, there has not been much excesses in the cycle in US, in India. What we've seen is China, where some of these excesses have happened, but rest of the world, you've not seen much excess happen. What happened was Fed tightened too much, and that tightening was done because look, your GDP grows, your inflation was running high, and you need to go back to a neutral rate of 3% very quickly. Else, with the real rates of 2.5%, the Fed risks taking US into a recession.
Interesting. So, Rahul, what's the call in India? Because our market as well, pretty unstoppable. And I don't think there's such a big question mark on the interest rate trajectory, at least here.
Yeah, no, I think India, what happens is clearly when does the growth recovery happen? So if you see last quarter, companies were blaming it on the summer. Hopefully nobody blames it on the rains in the September results which come through. So it's really a question on how good the festival season is. And then in terms of the capex, one knows that capacity utilizations are running at 77, 78%. So when does the capex starts coming through? And then somewhere again, I think if the government policies remain like it's been committed to capex, fiscal deficit in check, markets would kind of a shrug off the state elections, but they would have a little bit of an impact here and there in terms of if the ruling party doesn't win the state elections, that may just have some bit of a pure sentimental impact on markets.
Okay, but given the fact you're talking about slowdown in consumption, in real estate, etc., do you think it's time now to move towards the underperformers? Maybe book out your profits from real estate and auto, which did extremely well over the last couple of years, and move to the likes of financials, pharma, IT, for instance, perhaps, which were the underdogs?
So if you see last kind of a couple of months, we've been more on defensives rather than kind of the domestic cyclicals. And as we go closer to the rate cuts, one would move a bit from the defensives towards the cyclicals. But for somebody who's got a 3 month time horizon or a kind of a short term time horizon, maybe some profit booking may be warranted. But if the hope is that you could see signs of recovery after the first or the second rate cuts, then these domestic cyclicals, which is the industrials, real estate, again become attractive. And look, typically we've seen these are about 7 to 10 years cycle. So we are in year 3, 4 of the cycle. So anybody who's got a time horizon more than 6 months, let's say about 12 months plus, um, these names should be fine.
Having said that, Rahul, do you believe that the rotation that's happening in the market with IT, FMCG, pharma, along with now even banks beginning to participate in the rally, do you think that's sustainable?
Yeah, so I think what's happened is like what you guys were talking about. There's so much liquidity in the market, and that liquidity is kind of flowing in these sectors and move from economy sensitive to more defensive sectors, etc. Globally, as we talk to investors, there's still a lot of interest for India. So I think that is in a way, as people get more comfort on Fed's rate cutting cycle, people get more comfort on emerging markets improving growth trajectory. That money kind of flows to the EM funds and flows to India's, etc. So that's a positive. At the same time, we've seen a huge amount of fundraise also. So there is a sizable amount of fundraise which is lined up. If one is not mistaken, we may see some of divestment offerings coming from Government of India also, which is the best thing for them to do at this point of time to get the deficits down. So there is going to be a paper at the same time. But look, very few economies are growing at 10% nominal GDP plus, and that's where everybody wants to be part of the story. What one has to be careful is stay clear of the frothy segments, because historically, when we've seen that when you lose money, you can lose substantial amount of sums in the frothy parts of the market where you have weak businesses. You hear of so many IPOs where the business models are not proven, the managements are shaky, and ridiculous amounts have been raised. So I think that's something any investors has to be careful of and stay away from.
What do you make of this over exuberance that we are seeing? For instance, Bajaj Housing Finance just listed over 130% gain on listing. Today as well, it's higher by 10%. There are target prices of as much as 210 rupees a piece, valuing a housing finance company at 6.5 times book. In fact, that stock has hit the market capitalization of 1.5 lakh crore rupees, the first housing finance company to do that, and that's pretty much accumulation of the rest of the 5-6 companies which follow. And even Ola Electric, for that matter, it listed with that amount of momentum, cooled off a bit, and today of course there were a couple of initiations that happened on that as well. They are targeting upside of anywhere between 30 to 40% on that as well. What's your take on some of these kind of IPOs?
See, some of these things, look, it would be hard for us to buy something at 6 times a price to book, more so for a large kind of a banking or financial enterprise which doesn't have a good deposit mix, which doesn't have retail deposits, etc. So for us, it's phantom to build positions in this. And we've seen that markets can be irrational for a period of time. And when things correct, as we were discussing before, you can lose significant sums of money. So it's equally important to venture out to allocate where one has a good downside support, because the challenge with chasing momentum is that you become a victim of your own success. You start believing your own narrative. And then when things change, it is hard to come out of that mindset. So it would pay to be a bit disciplined here. That's the only thing I'll say here.
Right. Okay, Rahul, great speaking with you today. Thanks so much for taking the time out.
Thanks for having me.
If you like this video, then like, share and subscribe to ET Now.